So on this somewhat gloomy day, we're just going to bring a ray of sunshine talking about the economic shifts and the impact on venture capital and what's going on in a recession world. We were having our prep call and kind of jokingly being like, okay, where's the silver lining? What are we going to stay positive here? But no, it's just a shift in adjustment and mindset. And we have three folks that approach venture from essentially three different approaches. And so I'm really excited to hear and share with you guys a little bit about their perspective. But for those of you who I haven't met, my name is Emily Hack. I'm the Managing Director of Private Capital Markets for Insperity. We're in the HR business, we're in the people business, but also we're in the finance business. I want to make sure that our clients really are making the most out of their investments, particularly on the human capital side. But with me today, I have Chris Langford. He is a partner at Idea Fund Partners, but also brings a nice angle to this conversation in that he started the Lowe's Ventures, so from the corporate side. And then Zach Young, Scouting and Ventures Manager at State Farm. I'm still hearing me? I talk pretty loud, right, guys? We're good. So we'll hear from him a little bit more in a minute, and then Greg Brown. So he is the owner and president of Cardinal Finance, but most of us in this room know him for his leadership in Charlotte Angel Fund from an angel perspective and bringing us all in the know. And I personally have learned so much from Greg and the diligence and what I can glean from his experience on early stage investors. So with that, Zach, we are going to start with you because being not a charlatan, we would love to hear a little bit more about your role at State Farm. And we're going old school, much better. That way I can turn any way I want. Okay. Might have messed up my shirt anyway. So Zach, tell us about your role and your perspective on the shifting economy and how it impacts VC.
Sure, thanks. Really happy to be here. And as Emily said, State Farm might be a little less known in this area. So from a corporate VC lens, most people know State Farm for being the largest P&C writer of auto and home. We're actually the second largest writer of life insurance domestically, number one writer of small commercial insurance. So there's a lot of segments, and there's a variety of other offerings that State Farm brings to their customers. So from a venture perspective, we have a really broad scope. So of course, core insurtech technologies, but core fintech and even other broad technologies, health tech is all in scope for us. So there's a really broad thesis, and from a venture lens, about anything fits in the State Farm portfolio just due to the size and scale of the State Farm business. One other little piece, we, like traditional CVCs, we have a strategic relationship into the business, so into the core business and functional areas, as well as the traditional mandate from a VC lens. So to Emily's question, I think from an economic lens, when things kind of shift in this new world that we're in, I think you kind of see a pivot away from maybe a pure financial returns being the main focus, and there's a little bigger emphasis on the strategic lens. So for corporate VCs, we always talk about strategy, but when you really think about the impact that can be had, investment dollars are important, and when you have a really large balance sheet at a large corporate, you still want to be diligent in your finances. But ultimately, if you put capital into something and it creates a 10x, that might not be as material as if you can help a company run more efficiently, more effectively, saving a point on a combined ratio. For State Farm, we do 80 billion top line. So you can start to do the math there. So you just start to look at different focus areas and different way of addressing problems. And ultimately, it reshifts priorities. And you kind of have the proverbial margin call from all the business areas, and it just makes the priorities a little stiffer and a little more rigid.
Reshifting to the big picture ROI, right?
Yes.
So Chris, I love it when, through all of this, you make everything sound very simple in a world that's very complex. So tell us all what you mean when you say, hey guys, we got to just get back to the basics.
Yeah, let me just, can you hear this or should I? All right. I think the basics of venture is about business building, right? So it's about taking capital, setting milestones that progress towards hallelujah, cash flow one day, right? Some creation of value, and being able to stick to and hold yourself accountable to achieving the milestones towards this path, right? So I always say venture is a process of creating additional believability in what you're pitching me. At seed stage, it may be hard for me to believe. As you move through the stages, it should be a lot more clear that you have a path towards market share and cash flow. So I think one of the things of the last fund cycle was capital became weaponized. So when you think about the SoftBank Vision Fund and then all these other crossover funds, the theory was if I stuff $100 million of capital onto somebody's balance sheet, that they will emerge as the winner. So all I need to do is pick a space that I think is going to be relevant and big. I will choose the winner. It doesn't mean that they're the best operator. They're going to have the most capital. They're going to go out, they're going to buy market share. And by doing that and drowning out the rest of the competition, they're going to absorb, the profit pool. So I think when I say getting back to basics is I think clearly we're going to go into an environment where capital is less weaponized. It's less used against operators who are sort of progressively moving towards this state of cash flow. Clearly, we're going to start valuing this path towards cash flow in a way that we sort of just blindly said, go build something big and it'll all come out in the wash one day. And so I think that's just the basics, right? That should be exactly what people should be striving for, regardless when they're out there building. And so I think the number one thing is people are going to be held accountable. Now, in a world of infinite capital, there's inside deals and flat rounds and notes stacked on notes and all this next round of money that's willing to come in and all we got to do is make it to this hump of the Series A or the Series B or whatever it is. And that's going to dry up. And so I think entrepreneurs no longer are going to be held accountable for actually hitting the milestones or having a very highly believable plan that they can get to the next step. And that next step better be with an eye towards producing cash. Because when interest rates and cost of capital rises, the cost of $1 5 years from now becomes almost zero, right? So you need to start pulling that cash flow forward. So it's really just basic finance at this point, in a world where we kind of lost our perspective of basic finance for the last 5 years.
All right, you heard it here. The money doesn't always win at a venture conference. But Greg, when we talk about holding accountability, let's talk about the dreaded gap in valuations between what a founder believes the valuation of the company should be versus currently in this stage of our economy, what the funders believe that they need to do to get to that level. Can you share with us your perspective?
Sure. So I've been doing this longer than I should admit. I've been in and around early stage capital for about 30 years. And I think there's a bigger gap between founder expectation on valuation and where capital is than I've ever seen. And a lot of that, so we've seen huge moves in a very short period of time, right? So public company software revenue multiples went from 15 to 5 overnight, more or less, right? And I think from the founder side, the perspective is, well, we're in a blip and it's going to go back to there. And as Chris pointed out the other day when we were speaking and I said that, he said, well, isn't it, from a longer term perspective, isn't it really that period of time when the cost of capital was near zero, isn't that the blip? Rather than today with the cost of capital being what it is. And I think that's a fair point. So you have, at the moment, what I see in the early stage is there are companies that deserve funding that don't have capital at the moment because of this gap from a valuation point of view, right? Founders sort of holding the line and capital's holding the line. Eventually markets have to find some equilibrium, but I'll give you one specific, I can't use names, but I'm aware of a venture capital fund that has a new pot of money. They raised that money early this year, and they have not added a company to their portfolio since February. So these are people, they have real pressure to deploy that money, and they're not deploying it. And if you ask them why, they would say, lots of reasons, right? Every deal's got its own rhythm. They would say the number one reason is they can't deploy money. They can't find founders willing to take capital at the pricing that they feel like they need to deploy it at in order to make their fund economics work. And think about that for a minute. So they have real pressure to deploy money. Charlotte Angel Fund, we don't have that pressure, right? Our members could decide to go for a couple of years and just say no to every deal, and everybody's managing their own wallet. These guys are sitting there pulling hundreds of thousands of dollars a quarter of management fees, and they're going to start to get asked some questions from their limited partners, right? But they're holding the line from a pricing point of view. So I think you have companies that don't have capital that by all rights should have capital, but it's just a mismatch from a pricing point of view in terms of where it is that they have to be for the capital to be available. So those, there's some stagnation, I would say, on that front.
Right. And Zach, I think you bring some good points to this conversation on valuation of the target not necessarily being hyper growth anymore. Talk to me about your perspective.
Yeah, I know we talk about right now, related to what Greg was saying, kind of the goalpost just moves, and it moves with a lot of factors, and that's a recurring thing. But to what Emily said, we went through this time, really low cost of capital, which you've heard several times. And at that point in time, what got rewarded was triple digit growth rates and growth at all costs, and really showing that you can bring on customers and create traction. And I think now you start to see a shift where maybe the target isn't triple digit or high double digit growth, and maybe it's something that's a little more modest, but being done in a much more efficient and sustainable fashion, because now funds are being held to longer time frames, and ultimately what gets rewarded in this time frame we're in is probably something that leans closer towards projecting towards profitability or getting to profitability, or at least doing that in the most capital efficient manner.
I'll do a silver lining on that, just because we're trying to find silver linings in here. So funny enough, one of your counterparts, a very large insurance venture firm, the other day, and I were having a conversation, and we were talking about, we wanted to be part of a deal with them, and we were kind of pushing back on the valuation. I would say a year ago, we would have not batted an eye at what they were doing, but we just felt like, why are you paying this right now? One of the interesting counterpoints of this moment in time, and this idea of a bunch of people sitting on dry powder, was his belief was, a year ago, we would have been thinking about things as we want to put 30 bets to work because we think we're going to come across. We'd rather have more shots on goal a year ago to see which one kind of catches fire. And today, we've yes, we need to deploy this, but we're being more like team and founder choosy than we are necessarily capital. So his whole point was we actually wanted to give this team more money than they wanted. And so we overpaid because we're trying to concentrate our bets in a world of uncertainty. So that's a slight counterpoint to the idea of like valuation being constricted at certain points in time, and this idea of a lot of people sitting on dry powder.
Yeah, I'd like to, if I could, make a comment back to Zach's point about maybe, some businesses maybe having more moderate growth targets and all that sort of thing. I don't think that's incongruent with getting funded. Those companies can get funded. Charlotte Angel Fund would fund all day long a company that maybe we believe the exit opportunity for this company is $50 million, right? We would do that. We just can't start at a valuation of 10. Right? So, now that what I just described isn't going to work for every venture fund, right? But certainly the angel community, look, it's hard to build a business worth $50 million. It really is. And when that happens, it ought to be a win for the investors and the founders, rather than $50 million being a number on the table that the founder wants to take and the funders are telling him he can't take because that doesn't produce the rate of return that they need. I think those deals can get funded. They just have to their approach to capital has to be congruent with that path.
And I would love to do a follow-on question to what you just said, and all my questions are on the ground anyway. But you mentioned, and there's probably a lot of founders in the room that are would love to have your attention from a VC perspective. And you just said, hey, we're really investing based on the leadership team. So when you hear or see a pitch or meet a founder, what is it that you're looking at specific to the leadership team that gets your attention more so than the product and the potential sales opportunity?
Well, I guess I'll tie it back to the recessionary topic, which I think could be something, I mean, under every fund cycle, it's always are they experts in their craft, and do they have good character, and what have they shown in their life that suggests that they do excellent things and all this stuff, right? Like, that's the basics. I think right now in the recessionary environment, what I keep coming back to is how do you take feedback, like critical feedback, and like adjust in real time? Because every CEO I talk to, I'm like, okay, what's your plan? And then what's your plan plus 6 to 12 months? Like, who are the first people? What's the first product line you're cutting? What's the first thing you need to have the stay alive plan in your back pocket. So I think every CEO that we're underwriting now, we want them to be realists of the situation at hand. Being a CEO is a messy job. It's not always just like, I'm happy with it when it's up and to the right and money's flowing. It's like, sometimes you got to make hard decisions. And so I think one of the things we're doing in this environment is really trying to understand how they make capital allocation decisions within their business. Do they have a finger on the pulse of things that they can do to extend their runway that don't critically injure the business long term? And do they have a sense of the tripwires and when they need to start installing some of those plans? So I think that's probably the additional diligence we're doing on founders today as we head into a recession, that when money was flowing like water, we were more just like, hey, can you put this to work as fast as humanly possible and grow the business?
Yeah, one add there, I agree with everything you said, Chris, and just one add would be, compared to the environment we just came out of, I think a lot of founders and great companies had the luxury of having their core products and core offerings that they did well, and then being able to explore on the adjacencies and kind of bring other offerings to their current customer base and attract new customers. I think in this environment we're in now, there's just something to be said for whatever your superpower is, do it and do it really well, and just focus on that. And I think getting lost in, or not lost, but maybe distracted by additional offerings and other ways to attract new audiences, there's a time and a place for that. And now we're in this time where if you can, at least in a large corporate environment, really express what your value prop is and how you do it and how it brings value to all your customers, that really hits home in a environment we're in right now.
The other topic that I think is worth diving into a little bit is the LP environment. So what are we doing to inspire them to invest in the periphery, and how does their current take on the tightness of capital impact the overall venture community, and the Zach, you were mentioning earlier, the maybe for those who are more profitable but rolling a little bit slower, maybe that's your time right now. So, Chris, do you want to start us off on the LP kind of world?
Yeah, and I think we all have generally kind of slightly different LPs, so it'd be good to see how your LPs are thinking. But so for us, I think one of the biggest challenges we have is, as we're out talking to, say, institutions to back our next fund, one of the big issues is institutions have over allocated. They got on the venture capital train over the last few years. And when they make a commitment, they usually make a multi-fund commitment. So they say, Greg, smart guy, I'm in for your next 3 funds, 5 million, this one 10, next one 15, right? Something like that. Well, what happens is they are all managing towards a portfolio allocation, which might say 80% public, 20% private, and et cetera. So when the market corrects 20, 30%, that is known daily. Every day we know the price of the market and the price of securities that are publicly traded. In venture or private markets, there are these steps to pricing those assets, and those price corrections may not happen for 18 or 24 months. So now these institutions are sitting here and saying, wait a second, it said 80, I was supposed to be 80-20. Now I'm 70-30. So I've got to pump the brakes. I can't put any more capital to work in the private market. So that starts to dry up, and how that affects venture funds is now all of a sudden our spigot starts to get a little bit starts to run dry. So then we say, well, we got to start deploying slower, right? In the last fund cycles, people were deploying full funds sometimes in 18 months, right? They were coming right back out to raise a new fund. They were just like, fast as they get it, they were just like writing checks. And so
Fundraising is so fun.
yeah. Well, it was easier then, right? It was like people were, this LP dollars were wanting their product of venture, right? So it was like, let's grab as much AUM as humanly possible. And that encouraged behavior of deploy it as fast as possible. So the flow through is when that spigot gets cut off, then the venture manager says, I may not be able to raise a new fund, or it might be 3 or 4 years. I need to slow my pace, which then naturally means less deals get done, right? And that means more people, same number of people competing for less checks. And that's a secondary effect on valuations beyond just like the quote unquote cost of capital. It's also access. We have high net worth folks, but you're more on that side. So I think you could give a better perspective on sort of the high net worth as an LP and the perspectives.
Yeah, so I think everybody has any investor has similar asset allocation stuff, right? And what Chris said is true. You see your public stuff, it's mark to market every day. You don't know what these private things are worth, but all of a sudden you feel like you're overweighted there. I think what I think about a little more there is, if we're in an economic slowdown, and so if acquirers are a little less acquisitive, I think a little more about the flywheel of capital, right? So I think about this metaphorical table, and there are investors on one side and entrepreneurs on the other. And investors, they understand the start of the game is pushing money over to the entrepreneur side. But then you'll keep playing that game, you'll recycle your money, but at some point you say, that's the total that I want to have over there, right? And if I get $100,000 back from this deal, okay, I can redeploy that somewhere. If the return of that capital is slowed, then if the market is less acquisitive, then you're going to see, at some point, that's going to impact that wheel, right? And you're going to have people say, I've got as much on that side of the table as I want. This isn't about, I just need to see some of that come back. First of all, to give me some positive reinforcement that at some point some of this money comes back. And also just in terms of balance to my portfolio, get a little bit flowing back this way, and I'll throw it back over there. But I'm not interested in increasing the size of the stack on that side of the table. I think that's more the kind of individual angel mindset than institutional LP.
So Zach, entre you, is this an opportunity in the corporate VC world where these folks are slowing down more that a State Farm can double down?
It is. No, you're spot on there. So when you're investing straight off the balance sheet, we obviously don't have the outside constituents of LPs. And we look at it as an opportunity. And so that's why I go back to, if you know what your superpower is and you do it really, really well and you can articulate that to a large VC, to a corporate VC, now is actually a really great opportunity because we're deploying capital at just as rapidly of a rate as we were before because we see it as an opportunity, right? Where there's expectations that tighten in other places of the investment community. If something can really align strategically and make sense, again, and make a large corporation run more effectively, more efficiently, there actually can be better opportunity, and you could be getting better valuations, quite frankly, because of that strategic lens that runs into it. So, right, the silver lining here is there's always opportunity. It just might be in different corners of the market than where you're used to looking.
I mean, you can't discount. Sorry, you can't discount the profound difference between 0 and 4% risk-free rate of return, right? Like, if you just take someone who's say got, $5 million of net worth or something like that, right? When it's 0, you're like, man, what am I doing? I could put it in treasuries and literally just get back exactly what I had. That's ridiculous, right? all of a sudden that's $200,000 of cash flowing in your pocket in a highly uncertain, economy. Like, it's pretty hard to say, like, I'd rather just tie this money up for 10 years in completely illiquid manner on high risk investments. Like, there's just, even though the difference between like 20 and 24% return, I know compounded makes a difference, but that doesn't, but like 0 and 4, like, really changes the calculus of like that marginal dollar who's thinking about allocating to risk or not allocating.
Hey, 30 minutes ago out in the hallway, I had somebody tell me for the first time in his life he bought treasuries. That's happening.
3-month treasuries, 4%.
Yeah.
I mean, that's pretty good living right there.
So Greg, let's go through a scenario here where you have, gone through first round of funding with a founder that you believe in, and they've made great progress. And now you're in the economic situation now very different from when they first got their first round of funding. And they come back and they said, hey, we met all these benchmarks. We're making good progress. We're ready for follow-on capital. And talk to us a little bit how their expectations versus what the deals that are available right now, what do they look like, and how do those conversations go?
Yeah, so, to founder perspective, hey, my ARR is twice what it was when you guys invested, so you're certainly going to pay 2x what you did before, right? Simple math, that's how it should work. You say, well, gosh, I have to think about, well, at what pricing might we're doing all this assuming you can get to a Series A funding. So I have to think about, well, what might that valuation look like if you get to there? And that's probably at a different multiple than we paid first round, right? Is the truth. And so, there are certainly conversations around, look, I think it's great you went from, 300,000 of ARR to 800, right? That might happen over the span of one of our investments. That doesn't, I'm not just sort of going to rubber stamp, so you're at 2.5x in terms of either the valuation cap on this note or safe or the pre-money on this deal, right? Because we're in a different environment, and I have to be thinking, well, where might a Series A come in at? Somebody who's not already tied to this deal, where might they price their capital? Because our capital should be priced at a point where if that occurs, we should have made some money on this increment of capital, right? So, there's some uncomfortable. Look, most founders get it, and that conversation goes fine. The more quantitative they are, the better, right? In that, because it's they fully understand spreadsheets and yields and all that sort of stuff, but not always the case. Kind of last point on that, and just as a something, if you're a founder, to be sure you do, talk to your existing investors before you go to market with the next round. Understand their perspective on pricing and what they are or are not prepared to support. Versus, I've seen situations where companies went to market saying, this is what I'm raising at, without going to their existing investors to understand where they might have comfort deploying capital, which creates a pretty awkward situation, right? As the existing investor, if you feel like that's not priced appropriately, and you start getting calls from prospective investors about, hey, are you guys in on this deal? And talk to your investor base. It doesn't mean you can't go to market with a deal that your existing investors won't support, but you need to understand that before you go to market, and don't be surprised if that's going to occur. You don't want to be surprised by it.
So I think that leans towards some advice, some big picture advice on mindset And yes, we have a shifting economy. And no, we have no magic wand that takes you back to 2019 when we all wish we bought a house and got funding for our company. But here in 2022 and soon to be 2023, Chris, what would you offer as, big picture mindset or advice for a current VC level founder?
Yeah, I mean, I'd start with people always ask me, what's the number one reason why companies in your portfolio don't work out? And I say it's always because they run out of money. Like I've never had a company not work out that was self-sustaining, right? Like maybe it didn't get me the rate of return I wanted, but we didn't shut the doors on it when it was making cash, right? So the first thing is, it's great to want to be valuation or dilution sensitive, but you have to be alive sensitive as well. And like if the cost of capital has changed, then you need to like live in this reality. I think even when it comes to this concept of multiples, what's happened is so many people have taken this like tourism approach to like entrepreneur, like they've read TechCrunch and they've kind of like gotten this sort of idea. And in the math, what I constantly hear from people is, well, if this is a $1 billion opportunity, like you can pay 50, right? That's still 40x, right? And they just like they've disconnected the concept of math, of how math actually talks about a multiple, right? Like a multiple is basically just an inversion of either the discounted terminal rate, right? Or like the inversion of the cost of capital, right? Like real estate people get it. They talk about cap rates all the time, right? Like it's a known thing that a multiple is just like an inverse principle to cost of capital. But founders, when they talk about it, they talk about this obscure possible gigantic outcome and how much you'll make if they achieve that, right? So I feel like that's the argument that I continue to hear is like, well, if I become a unicorn, you'll make X. So you should continue to pay an exorbitant multiple for it, as opposed to the logic, which is you'll never get a Series A if I pay, or a Series B if I pay 50 now, which then you'll be dead, you'll have no money, and you'll make zero, right? And so I think it's really easy to sit and say, man, I wish I had done this in the past, or I wish that like I could have been a beneficiary of some other time. But I think money's out there. There's more dry powder than has ever existed. I think investors with that money want to put it to work, right? They want to put it to work at a reasonable rate of return. So like just come to the table and disassociate like that it's some sort of valuation of you as a human, right? And just say, this is the way money's changed, and keep the business alive. And if you get to that outcome, I promise it'll all work out in the end.
Thank you. We do have about 8 minutes left. I have a couple other questions I could ask, but I would love to open up for Q&A from the room. Does anybody have questions for our panelists? Got one back in the back there.
Valuation multiples are you seeing right now? So what would you say is what valuation
multiples would you say are most common right now?
It's almost not applicable in the angel space, right? Because really, deals aren't being priced on a revenue multiple. So, I don't know that I can answer it from a multiple point of view. What I'll tell you is that very much the standard ask these days is, hey, I'm a startup. I've done a little bit of stuff, but not a lot. I'm raising money on a safe with a $10 million valuation cap is sort of the standard ask. And that's not being well received. So it's somewhere below that.
I was going to say I agree.
Yeah, I think it's all over the place, right? The earlier stage you go, the more art and the less science that there is to it. I think it's pretty fair to say that I think if you're talking SaaS, like I think it's fair to start at the like 10-ish range, 8 to 10, and then move the barometer. Is this great? Is it growing 300% year over year? Does it have a greater than 100% retention rate? Like all that kind of, like if it shows exceptional metrics, there's still people that are willing to push that somewhere between 10 and 20, right? I think the days where that's 50 and 100, not that that really pervaded a lot in the South, but I think that's probably getting carved back a lot. But I'd say, I think if you just start at like 10 as the barometer, and then you start to layer on factors of like growth, team, intellectual property, moat, and things like that, you're probably a good calibrator to go plus or minus a couple turns from there.
How would you go about a company that's been in the works for 8 years and is a blockchain tech company that has some of the highest tech in the world, but it's pre-revenue, and you have to advocate to your investors that, hey, this technology is like on par with the car or internet? What would you do to go about valuing that?
Yeah, I'll take that one at least. So broadly, like across financial services, blockchain obviously is not a new topic for anyone in this room, I assume. And we see a lot of companies in that space, been around, tenured, conviction around the solution, some strong IP. And strictly from the corporate angle, I'll say where there's a gap is generally really having a use case that can be articulated for whomever that is you're going to get capital from, right? Like, we sit within the insurance space at State Farm, but there's a lot broader solutions that we bring to the market. And a lot of blockchain specific folks that come to us can't generally articulate what a good, whether it's actual insurance, claims tech, health tech, et cetera. They can't articulate what the use case is. They generally just come and say, look at how cool this technology is. And you just can't get from that side to saying, how can you actually use it? And so we never end up getting to that valuation portion. There's a lot of belief and conviction across financial services and blockchain. It's not a if, it's a when situation. I think that there's mass adoption. So I think it's really just getting conviction around what the use cases are and maybe even tailoring them to whomever you're speaking to try to get capital.
I think if you just replace the word blockchain with deep tech, meaning take an industry where it's perfectly normal to be 8 years old and have no revenue because the value is predicated off having truly novel and world-changing technology. Nothing's changed, meaning you need to go to someone that can truly underwrite the technology. That's the only investor who's going to give you a reasonable valuation at this point. Like if you came to me and said, like, I can cure cancer, I would have zero ability to underwrite that. I'm not a doctor. I don't know anything about it. I'd have to so I'd say, don't talk to people who are on the fringe and can't underwrite your claims. So you need to get a lead investor who is a deep tech or blockchain expert, who then can be your evangelist to other investors who look up to that person as an underwriter. So that would be the only way that I would get in on something like that, is if someone who I knew that was like, that's my person who underwrites blockchain for me, and they are telling me this is world changing. That would be the only way that I would get in. But I would just say you just got to focus on people that can validate your claims of it being so technologically superior that it will one day produce exorbitant profits to value it in that way. And I don't think that's changed. I don't think that has anything to do with the recession.
No, there was never a multiple. So it's all based on discounted cash flows, right? Yeah, and you're going to apply a different rate. So I'm sure that math is going to work out differently than it did when you were using 1% of the cost of capital. So it will impact your valuation there.
Sure. I don't think I need the microphone. I'll speak loudly. It seems like founders have a big, long list of to-dos, right? I mean, pages of maybe things to their to-do list. What are some to-don'ts? What are some things that they should keep in mind as they come and and ask for money that you just that's not going to work, and please shy away from that?
So to don'ts. I mean, so there are no absolutes, right? There are companies raising money every day that I look at like nobody's ever going to fund that deal and somebody does, right? So I don't know, right? But just understand. So don't go to market with a deal that's removed from the norms without knowing that. There's so much available information out there. The internet exists, right? You can find out how deals are usually done, what structures, so if you go to market with, everybody's got to own their own capital plan, right? And if you think the right way for you to raise money is not on a note or equity, but to do some rev share deal in the future, go to market, fine, you own that, but just understand the ramifications of that in the market, and that the universe, raising money is hard. Here's the universe of funders, and it got that big when you said we're going to do revenue share, right? So just, don't go to market outside of norms without having done your research and understanding the implication of that. Would be mine.
I already said this probably a few times, so I apologize on repeat, but I think don't get distracted by what maybe the competitors or the market is doing, chasing multiple tangential solutions. Do what you do really well, know how to articulate it to people, and just make it the best solution in the space. Because I think there's still a lot of ways to win. And sometimes people get distracted at trying to be all things to all people. And so just know what your value prop really is and continue to do it well.
We are rounding out our time here. So I just want to say thank you, Chris, Zach, Greg. Great insight. If you had more questions, they will be around a little bit this afternoon. I'm not sure what their plans are tomorrow, but also want to say a big thank you for RevTech Labs for putting on this a great event every year. Gosh, Ashley, Richie, Dan, you guys are probably ready to take a big nap later this weekend, but I think this is a great way to share knowledge and get people in the right room to move deals forward in a space that continues right now in our current economy to offer up new and surprising challenges every day. So cheers to what's next, but together we can tackle it.
All right.
Thanks, guys.
Thanks, Emily.